So this is picking up in Chapter 7 where we left off after the overview of financial statements. So now we're going to talk about departmental operating report. So these reports break down revenue and expenses to the individual cost center. It's used to provide rationale for why there is a positive or negative variance in a particular cost center. The DMP nurse leader must be able to explain variances fully and develop action plans to manage these variances. An example of a payroll variance. So in this example, there were patient days. So this is the number of days that we anticipated on the budget, which was 450 patient days. The actual was 500. So there was a positive variance of 50 patients days over the budget. Payroll dollars. So the payroll dollars were budgeted of 209,854, and there was actually 249,854. So it was $40,000 over budget, or a negative variance. The cost divided by the patient day. So on the budget, we would anticipate that payroll would be more because there were more patient days, but it doesn't necessarily mean that the more payroll is justified. So we originally budgeted for $466.34, so per patient day. But we actually spent $499.71. That's $33.37 per patient day more than budgeted. So the analysis, the volume, what portion of the variance was related to volume? So if you want to calculate this, you take the additional 50 patient days that we calculated here, and you multiply that by the budgeted patient per day cost. So 23,317 of the 40,000 that we were over is related to just volume. So of the 40,000 in payroll variance, only 23,000. So that means there's an additional 16,683. So was that related to transfers, overtime, supplies? So as a nurse leader, you would need to dig into why is that variance more than volume? So talking about depreciation, it's the loss in the value of the organization anticipates for building and equipment. Prematurely replacing capital equipment before it has fully depreciated can result in significant write-down of asset values. So this can affect the balance sheet and the income statement. So earnings before interest, taxes, and depreciation and amortization, also known as EBITDA, is how much money a company earns if they did not have to pay interest, tax, or take depreciation or amortization. Another key performance indicator for a hospital or for a healthcare related entity is paid claims ratio. This hospital bills, it's the hospital bills versus what they actually collect. This metric is similar to asking, what do we collect on every dollar? And then year to date, also known as YTD, is the period starting from the beginning of the current year to present day. So year to date would be all the way through today, September 4th. So we're going to move into financial ratio comparisons. So these are comparisons of numbers referred to as ratios. Ratios should be compared over a given time frame. The ratios are more valuable when they're compared to a stated regional or national benchmark. So for example, if you looked up healthcare industries, there would be national benchmarks for average ratios on a healthcare related business, and then you would compare year over year from your current company and the national standard in order to analyze what's going on. Is cash going down? Is cash going up? Are we becoming more efficient? Are we spending a lot more money? What's that related to? Liquidity ratios provide insight into the organization's ability to meet its obligations over the next year. How quickly can we convert to cash, right? Solvency ratios provide insight into the organization's ability to meet its long-term obligations, so long-term debt and capital leases. Common size ratios provide an indication relative to the size of the organization. For example, if you're making a comparison between two hospitals, one might be significantly bigger than another. So if you put them into what we call common size ratios, then you would have a comparison that takes away the difference based on size. Profitability ratios provide insight into an organization's ability to produce profits and cash flow. And efficiency ratios provide insight into how efficient the organization uses its resources. So a current ratio. The current ratio is an indicator of whether a hospital has enough resources to pay its debt over the next 12 months. It compares current assets to current liabilities. The current ratio helps investors and creditors understand the liquidity of an organization and tell how well that organization is managing its liabilities. A current ratio is more favorable, a higher current ratio is more favorable than a lower, and it shows the organization can easily manage its debt. It's calculated by dividing current assets divided by current liabilities. I'll walk through an example after we go through the slides. A quick ratio. A quick ratio measures the current assets, not including inventory, per dollar of current liabilities. So basically we use the one we just took, but we subtract out inventory. The reason being, many times it's hard to convert inventory to cash. So therefore we want to know, like, excluding inventory, how quickly can we convert all of our other assets to cash? Then there's the debt ratio. The debt ratio is another ratio analysis of liquidity that compares the organization's total debt to total equity. Now, in a nonprofit organization, it would be compared to net assets. The debt ratio is defined as all assets bearing non-interest liabilities. The debt ratio defines debt as interest-bearing and non-interest-bearing liabilities, making it the most inclusive of capitalization ratios. The debt ratio shows the percentage of financing that comes from creditors and investors. The higher the debt ratio, the greater the amount of debt financing. How you would calculate it? Total debt divided by total assets times 100. Then we move on to a total margin percentage. This is net income divided by total revenue. This calculates the organization's ability to control expenses by measuring the total profitability as a percentage of revenues. The higher the total margin, the better. Please note that the total margin includes both operating and non-operating revenue. So an organization could be at an operating loss, but if non-operating revenue were large enough, you would still have a positive margin. So the way you calculate this is net income divided by total revenues times 100. Return on assets. This ratio is a profitability ratio that measures total profitability as a percentage of total assets. It provides guidance on how efficiently an organization uses its assets to generate income. Often, we refer to it as return on total assets. The higher the ratio, the more favorable the organization is to investors, as it shows more effective management of assets to produce a greater amount of net income. Positive ratios always indicate an upward profit trend. So you would take net income divided by total assets times 100. Days cash on hand. What is it? Days cash on hand measures the number of days that an organization could continue to pay its daily cash obligations without any new cash resources. Higher values imply higher liquidity and are viewed as favorable by creditors. However, organizations should avoid holding too much excess cash and short-term investments because this typically provides a lower return than long-term investments. So the way this would be calculated is cash plus short-term investments divided by total expenses minus depreciation divided by 365. Days in AR is a measure of average time it takes to collect an organization to collect on what's owed. It provides an insight on how effective the organization is at managing receivables. The shorter the average collection period, the lower the dollar amount of receivables, which leads to a lower carrying cost. The way you would calculate this is net patient AR divided by net patient service revenue divided by 365. Average daily census. This is the average daily census number of patients treated during a given time period. It provides a measure of inpatient volume on the basis of number of patients because a higher number spreads fixed costs over a greater number of patients. A higher average of a daily census is considered beneficial as it tends to indicate higher profitability. The way you would calculate this is the total number of inpatient services for a given period divided by the total number of days for that same period. Inpatient bed occupancy rate / bed utilization rate. The occupancy rate is an actual number of beds, inpatient beds occupied by patients over a given time. It is expressed as a percentage of total beds. The ratio is used to gauge the appropriate balance between demand for inpatient and the number of beds available to provide inpatient care. The occupancy rate is calculated, shown below, to show the actual utilization of inpatient health facility for a given time period. The way you would calculate the occupancy rate is total number of inpatient beds occupied divided by the total number of inpatient beds available times 100. So now I'm going to walk you through an example of critical thinking exercises. So these examples you can follow along in the book. I've also posted this on Moodle. So the invasive radiology department has just purchased a piece of equipment that enables them to perform many of their procedures faster. One of the results of this improvement is that they are able to schedule 20% more cases on an average weekday. During the pre-planning of this improvement, the director of short stay was not included and was told her staffing needs might need to be increased by 10%. After the first month on the use of the new equipment, the short stay unit had the following variances. We want to know which ones are negative, which ones are positive. What does the director need to report to senior leadership as to what had happened and why, and what does she need to do to make the appropriate adjustments? So, that's the answer sheet. I'm going to open the one where we work through it. Okay, so the hospital, this is critical thinking exercise. So now we need to calculate which variance is positive and which one is negative. So they gave us the information and we calculated the variance. So we have a negative variance. We have a positive variance on volume. Positive. So we saw 200 patients more. We really should calculate it like this. So a positive variance on volume, negative variance, so we spent more on overtime and supplies. How might she explain this? So to answer what caused this, we might have to calculate average. So if I wanted to calculate average for overtime and average for supplies, here's how I would do that. For overtime, on the budget, I would take the number of budgeted hours divided by the volume. That's how much we think is going to happen, so 5%, right? Based on 1,000. So assuming that there was no efficiency problems, this would be the same number. So now we take the actual divided by the actual volume. Well, that gives us 6.25% or 6.3, it's rounding. So we actually were not efficient in our overtime hours. There could be many reasons for that. Let's see about supplies. So our supplies divided by the hours is basically $5 per patient. Now, if I take this, so we ended up only spending $4.25. So my explanation, without further information, would say that the variance on overtime was not efficient. So we did not gain efficiencies in overtime, but we did on the use of supplies based on this new equipment. Now, here's what I would want to say. We only have 1 month, and when people use new equipment and a new process, there's a training time. So I would want to continue to look at these numbers in order to determine, is it just that we were getting used to it? So the way that overtime and managing the volume with the new equipment was not accurate for long term, or is it that there weren't efficiencies gained in staffing? So we would need to continue to monitor this and compare month over month. All right, so moving on to critical thinking exercise number 2. So use the information in the table to complete the blank rows So they want to know actual patient days and budgeted patient days. So they want to know the actual. So all I would do is take the actual in January and minus the budgeted. So actual, there's a way I could take a shortcut in Excel, but I won't do that yet. Minus budgeted, actual minus budgeted equals actual minus budgeted equals actual minus budgeted. So these are the variances by month. So this would be no variance. This would be a positive variance in volume of 22, positive variance in patient days of 78, a negative variance of 84, positive of 62. Now we're going to go to actual nursing hours. Actual minus budgeted. Actually, for hours, we would want to go budgeted minus actual, because that'll give us whether it's positive or negative. So we had more, a negative in hours is more. So if I just do this, it'll calculate the formula for me. All I did was click. Let me just undo that for you so you can see saving steps in Excel. When I have a formula and I want it to go down the whole row, just double click. So we have a negative variance in hours here, a negative variance in hours here, but we had the same budgeted patient days. So we spent more hours, same budgeted patients. So we have an efficiency problem with hours. We need to look into that. This same thing, so this had 22 more hours. So now we'd have to calculate what were the hours per day and how far were we off? Was it off because of volume or was it off because of efficiency? And these were positive. So this one was positive, even though we had more volume. Intriguing. And then this one was positive, but we had a significantly less days, patient days. So again, we would need to dig into this, but this is how you calculate the variance. And moving on to exercise 3. So this is an example of depreciation and net book value. Okay, so in this example, your hospital replaced its entire patient bed fleet 10 years ago, or 120 months. And the nursing departments are stating that they need to replace it again. The beds were originally purchased for $15,000 each, and the replacement beds from the same vendor are now $20,000. At the original time of purchase, the beds were assigned to a useful life of 15 years. That's how long we anticipate they'll last. But now, 10 years in, the nursing staff wants new beds. So what is the net book value or remaining depreciation on the organization's 200 beds? How would we calculate, how would net book value influence your decision making to support or not support this request? And as a nurse leader responsible for stewardship of financial resources, assuring patient quality outcomes, and maintaining an engaged workforce, how would you proceed in balancing these three requisite responsibilities of your role? All right, so first let's put down the given information. I always set up my problems like this. There are a number of beds. Number of beds. Okay. Right. So my number of beds is 200. Okay. Cost per bed. We said that was 15,000. I like to format my numbers correctly because it makes it harder to read if I don't do this. So I'm just taking this information from the problem. So useful life is 15 years, and years completed is 10. So calculate original purchase price. So the original purchase price would be the 200 beds times 15,000 per bed. So next step, calculate depreciation per year. Okay, you take the original purchase price, which is 3 million, we calculated above, divided by useful life. which is 15 years, and we get depreciation per year. So 3 million divided by 15. So it's 200,000 in depreciation per year. So now to calculate net book value, or NBV, we take original purchase price actually we would take depreciation per year, which is 200,000, number years completed. So in this example, 10 years have gone by. So this would be accumulated depreciation. This is all of the depreciation we've taken. So 200,000 times 10. So 2 million in depreciation. So then we would take the original purchase price of 3 million less accumulated depreciation of 2 million. I put a negative sign there. So net book value is the sum of these two things. Okay. So at this accumulated depreciation is this auto sum. So therefore, on the books right now, we have $1 million. If we wanted to replace those beds, we would need to take a write-off of whatever the net book value is. This would go to depreciation expense. So in order to go to depreciation expense, it would impact the financial statement. So we'd have to take that as depreciation expense. The next thing we would do is purchase price of new beds, which is 20,000 per bed, times the number of beds, so times by 200. So we'd spend $4 million, and we take a $1 million write-off on depreciation. So would you want to do this? The answer isn't extremely easy. We would need to know, what is the patient outcomes that we're looking for? Are we going to have gain revenue or scores or achieve some strategic objective by replacing the bed? And I think this is where it gets tricky. You have to relay this message to nurses who are like, what is depreciation and why would that matter? So I encourage you to think about, why would that matter and how would that work? So I'm going to post these, and these are examples. I'm going to make a separate video walking through the financial ratios of Bay State. But that will be a separate video.